So, good afternoon, all dear students, and welcome back to the session of financial management. Today, we go for the revision class of Unit 1, specifically Part 1. So, let's start. So, our subject is financial management, and our first unit is Introduction to Financial Management. So, we need to understand the meaning of finance and financial management. These are the content that we need to learn in unit number 1. Okay, and here you can see finance plus management is equal to financial management. So first try to understand the finance. So please remember, the finance is the lifeblood of any business, and it is very important for each and every type of business. Here finance means it includes a capital, investment, fund, money, coins, currencies that the businessman have and that businessman invested in the business. Okay, I hope the simple meaning or a definition of finance is given to you. And here, finance means art and science of managing money. Or in according to the Oxford Dictionary, finance means management of money. Please remember this definition that may be asked in 1 mark question. Okay, now we go for the next one, and that is the types of finance. Here we have two types of finance: private finance and public finance. Public finance means money or a finance or a capital available with the government. That may be a central government, that may be a state government, or that may be a local government. And private finance means money available or finance available with the person and with the business. So any investment or any money that we have invested in the business, that called a business finance, and money with you and me, that is called as personal finance. So mainly we have two types: private and public. And again, the private is categorized in two different categories: business finance and personal finance. Okay, and then after we have tried to understand the definition of financial management. Please remember the definition given by the H.C. Kushal. The definition of financial management is like: financial management deal with procurements of fund and their effective utilization in the business. So, financial management means procurement of funds and use of that fund in the business. Okay, some of other definitions are there that we are not going for the details. Okay, now the next and most important question for all of us, and that is the scope of financial management or various decisions in the financial management. So mainly we have three decisions: investment, financing, and dividend decisions. In a modern financial management, we have fourth decision that called working capital decision. So let's try to understand one by one your investment decision. So first of all, we need to define our business plan, and then we go for the development of investments. So investment here means investing the money in the business. That may be in a building, that may be in a plant, that may be in a factory, that may be in a machineries. Okay, in technical language, we call it capital budgeting. Separate unit is there, unit number 3, that is all about investment decisions and capital budgeting. So detailed practical questions we will do that in unit number 3. So here investment decision means company need to decide where to invest, in which assets company must invest: in buildings, in plants, in factories, in machineries. Okay, and here we try to define some of investment proposals or investment projects which help us to get a more return. Okay, so for calculating that return or to getting the best project, we need to measure three things: time, risk, and return. So this is all about investment decisions. Now number 2, financing decisions. So in a financing decision, mainly we have three criteria, three different categories that we need to understand. Number 1, sources of finance, from where the companies get the money. So mainly there are four sources. Source number 1 is equity capital. Number 2 is a preference capital. Number 3 is debentures, and number 4 is uh, internal sources. Okay, so mainly four sources are there. Next is a cost of finance or a cost of capital that we have studied in unit number 3 or unit number 2. Okay, here cost of equity capital, cost of preference capital, cost of debentures, or cost of internal sources. And next one, the financing mix. It is also known as a capital structure, okay, in which we try to define the ratio of equity and debt in the capital structure of the company. So the financing decisions mainly concerned with the three aspects: from where company get the money, sources of finance, cost of money, cost of finance, and financing mix, a mixture of equity and debt. Number third decisions, that is dividend decisions. So here in a dividend decisions, mainly it's about how the companies are paying dividend, how the companies are distributing dividend, which policy company has adopted, and which form companies are paying dividend in form of case, in form of check, in form of stock, in form of bonds, or in form of other securities or other properties. And if company does not pay that profit, or company does not declare the dividend, then that profit must be reinvested in the business. That is called retained earning. Okay, so dividend decisions means how the company pay the dividend, in which form, which policy company has adopted for the dividend distribution, and if there is no dividend, then how company go for the reinvestment on dividend. So this is all about the three different decisions of the financial management. Okay, and the fourth decision is about working capital management. That is the part of modern financial management. So when it's come to a working capital, it means a capital required for day-to-day financial activities, day-to-day operations. So working capital management means management of short-term finance, specifically management of cash balance, bank balance, bills receivable, bills payable, debtors, creditors, all this. So ultimately, this decision, working capital, is deal with the current assets and current liabilities of the company. So these are the main four decisions of financial management that we have looked at weekly. Now moving for the next practical next question, and that is objectives of financial management. So mainly two objectives are there: profit maximization and wealth maximization. So each and every business is started and is it's operating their operations to earn a profit. The main aim of any kind of activities or any kind of business is to earn a profit, except the government and non-profit organizations. So main purpose of any business is profit, and to get that profit, company is number of ways. Okay, they can increase the sales, they can increase the market, they can increase the number of customers, they can increase the market price of the products. Okay, they can increase uh, other factors. Those help us to get more customers, to get more market area, to get more sales in terms of unit, in terms of rupees. And second, to get a maximum profit is to minimize the expenses. Okay, only two ways are there to get the maximum profit. Number one is company can increase the incomes, and company can reduce the expenses. By both the ways, company try to maximize the profit. But here, this concept, this objective is near objective. It is a traditional approach. Why traditional approach? Because company mainly focus on the profit maximization. Company ignore the other factors. Okay, and in the real world, in the practical world, it is so difficult to survive in the market with only profit maximization. So that's why this profit maximization have some limitations. Okay, these limitations are here in this slide. Okay, number one, it is an narrow concept. It is mainly focused on profit only. Number two, it's ignore the risk and time value of the money. Okay, and it's mainly for a short run profitabilities. It's not useful for the long run profitability. So these three are the limitations, and just due to these limitations, new concepts come in the picture, and that new concept means wealth maximization. Okay, so second objective of any company is wealth maximization. Here, wealth maximization means maximizing the net present value of the business. Here, net present value means total value or that company have in terms of wealth, in terms of total finance with the company, and those are available with the shareholders. So specifically, when company comes to a wealth maximization, it's mainly about how company get a maximum value of its shareholders or to the shareholders. Okay, mainly two ways are there. Okay, here we are discussing wealth maximization. It means maximizing the wealth of the shareholders, and shareholders receive their wealth either through a dividend, either through a capital gain. If you remember, we have discussed example of Reliance Limited. Okay, and that is share price of Reliance Limited in 2014 and 2020-21. So this is the first way, and second way is about a dividend. Okay, as a company declare the dividend, this dividend is a part of profit. So ultimately, profit transferred to the shareholders. So there are two ways which help companies, which help shareholders to create the wealth. Number one, by declaring the dividends and by increasing the market price of the shares. So both the ways are help us to get a maximum wealth. And so this is our second objective of any organization. Fox objective is profit maximization. Second objective is wealth maximization. And this wealth maximization is again having only one limitation, that it's ignore the other stakeholders. It's ignore the public. It's ignore the society. It's ignore the environmental, protections and all this. So these are the only one limitation of this wealth maximization. And with this, our topic is over. Objectives of financial management. Okay. Now, next point, financial management and other disciplines. So financial management is not a separate, but it is directly, indirectly related with the other disciplines, other subjects called like as financial management and economics, financial management and accounting, financial management and mathematics, financial management and production management, financial management and marketing, financial management and human resource. Let me take only one example. Okay, see, in economics we have called rule of demand and price. Okay, rule of demand. So if the price increase, demand will decrease. If the price decrease, demand will increase. Similarly, okay, in financial management we have some rule. Okay, if you remember the dialogue of Ashwat Mehta, okay, risk hai to isk hai. So as more risk, you will get more return. As less risk, you will get less return. So from that point of view, this both the subjects are similar. In accounting, we have some statement, we have some accounts. In financial management, we have some calculation, we have some statement. Okay, so we have some stable. So from that point of view, this both are same as compared to mathematics. In mathematics, we have formula. In financial management, we have formulas. Okay, but of course, calculations are different, but the fundamentals are same. So from that point of view, this both the subjects are interrelated. Now the next very important point, and the last point from the part one, role of finance manager. Okay, so mainly two functions are there. Traditionally, we have uh, financial management as a controller. Okay, so he or she just need to observe the things that going in the organization, that just they need to control. Okay, then there is no any other aspect or role done by the finance manager. Just financial managers need to see that from where companies are getting the money from where company utilizing the money. This all are the things that traditionally financial management need to see. But in a modern financial management, he need to play or she need to play say so many roles. Okay, and these roles are here. So if the question asks that right role of finance manager, you need to write this all the points. Okay, number one, rule number one, provision for capital. Okay, finance manager is responsible to get the money for the business. Okay, he need to maintain a sufficient balance of the money with the company. Number two, investor relations. Okay, investors relations. So here it is a role of finance manager to maintain the good relation with the investors, relation with the shareholders, with the bankers, with the financial institutes like this. Number two, investor relations. Number three, short-term finances. Here, short-term finances means finance for less than 1 year. So, if company required money for 1 month, 2 months, or 1 week, 3 week, or 6 months, that requirement must be fulfilled by finance manager by getting the short-term loans from the bank. Next is banking and custodies. Okay, so this is the very important role of finance manager, that he need to maintain all the records. Okay, all the records about the transaction with the bank and other financial institutes, like as a passbook, like as a checkbook, like as account statements. All this maintained by the finance manager. Next is all about credit and collections. Okay, credit and collection. So, how many days will allowed to the customer to pay the bills, that decided by the finance manager. So, finance manager decide the credit policy, credit terms, and how company collect the money from the customers from the other third parties. That policy is again decided by the finance manager. Next is insurance. So all the tasks related to insurance, okay, insurance premiums, insurance agreement, okay, a collection of insurance coverage. This all the things will done by finance manager only. Next is investment. Okay, if the company has some surplus fund, then that surplus fund must be invested somewhere. So where to invest, that decided by the finance manager. So it is the role of financial management that he decide from where company get the money and from where to invest the money. Number next is planning for a control. Okay, here planning for control means planning for money control, not a control over the people, not control over the material, but control over the expenditures, control over the money of management. Next one is reporting and interpreting. So each and every year, the finance manager is responsible to compare the reports that prepared by the account department with the last year, with the past data, and based on that, he will take some decisions, and he also report the same to the board of directors for future plan. Okay, next one is evaluating and consulting. So here, evaluating means evaluating the investment proposals, and whenever it is required, it also provide a counseling services to the company, to the various departments, to the various managers about planning of or investing of monies. Next is tax administrations. So tax related policies and practices will be fulfilled by tax finance manager only. And next one is government reporting. So whenever the government required any report regarding the money, regarding the capital of the company at the time, the finance manager is responsible. It is a role of finance manager to provide that all the details to the company, or sorry, to the government in behalf of company. Okay, protection of assets. It is again the important role, because whenever company required money, company generally use assets, okay, to get a loan. Okay, so your role of financial manager that ensure that all the installment of loan is paid on time, there is no any due installment, and with this that finance manager can control the uh, finance, plus they protect the assets. Next one is economic appraisals. Okay, here economic appraisal means whatever the changes are there, external changes specifically. Okay, the change in the government policy, change in the economic conditions, change in the social criteria, okay, some of the government decisions, government rules, policies. So according to that, he need to take decisions regarding the capital, regarding the money. Next one is managing the funds. Okay, as we have discussed in the last two sessions, okay, that whatever the money is there, that all the money is maintained or managed by finance manager only. Okay, measuring the returns in annual reports, company publish the reports. So it is a role of finance manager to check that annual reports, to measure that returns, that what is net profit in 2017, in 2018, 2019, 2020, 2021, or what will be the profit in 2022. Okay, next is cost control and price setting. So here finance manager try to control the cost over a production, over a staff, or a supply of goods or a supply of raw material. And plus he also help our managers, other managers, specifically a sales manager, to decide the price of the product, price of the service. So these all are the uh, role that played by the finance manager in the modern era. And the last two roles are there: forecasting the profit and forecasting the case case flows. So here, forecasting means estimating the future profit and future case inflows. So based on the past data, based on the relevant data, the finance manager decide a future data, decide a future sales, decide a future profit, or estimate future case inflows. So it is a role of finance manager. So if you can remember, there are 12 to 14 points are there, but don't worry, you are not supposed to uh, remember all the points. You can remember only 7, 8. That is enough for you. So in this revision class, just we have tried to understand the finance. Okay, we have tried to understand uh, types of finance, financial management, a definition of financial management, important decisions in financial management, objectives of financial management, and lastly, we have discussed the role of the finance manager. So, with this, a revision of first part of Unit 1 is done from my side. Okay, thank you.